Welcome to Kaplan. A Happy New Year, and one coming up very soon as well. It's nice this year, right? We have continuous like 5-6 days in a row, but it's good time so you can start studying before the exam. So most of your questions would probably be answered by Joe just now, logistic and other requirements. So here my role will probably be from a different perspective. It's more like I really want to have it now because it's a must-have. So how can you get it easier? When you look at the pass rate, it's actually pretty high. When I talk to students that I had or other members, most that don't pass is not they don't know the material, it's they don't have time to study. I mean, no one has time to go home 2-3 hours every night to read the book. We have family, friends, other commitments, so that is where we come in. When you look at the material, it's actually very, very interesting. If you buy the Kaplan material, you don't need to buy the actual book, but I actually recommend you buy it as well because it's tons of fun stuff, good stuff in it. It's very useful. But it's nice to read, but it will take a long time. So our role here is to, there's two parts. One is have you understand the concepts in a much faster, easier way. Because when you look at the formula, it looks terrible. But when you strip away all the formula and how to make it work in all situations, most concepts are pretty simple. The other one is being a CAIA member myself, I want to make sure we have high standards, in the membership. So I'm trying to put in another part of real life. How does it work? Because let's say you're working for a hedge fund and you want to change your style, work for someone else. So you go for interviews, you look around to see if it fits you. So CAIA has a very good broad-based information, so you know what they do. You meet a friend that's in something else, private equity, you can talk to him so you know what he does. Maybe not in great details, because that's trade secrets, but you know what he does. So if you're interested, you can get in. It's more choices when you have more general knowledge of what the other person does. Just because it's not like CFA. Everyone does the same thing in CFA, but here, all the major asset class, everything works very differently. Some has certain strategies, some are traded and alpha return on other things. So having CAIA is very good in knowing what everyone else does. Networking is very good. So being a CFA myself, when you go to the CAIA function, you have you can call the big guys coming to the function. Very friendly, the top of the firms. When you go to CFA function, you have 100 students and two guys from management in the back. So it's not the same thing. So here, I guess my role would be more of what we do in class. What I want to hear at the end of the course is for you to think. I paid not too much money to come here on the weekends, but I found after I went through Thomas' class, I don't really need it because the concepts are simple. That's what I want to hear. Because if you read the book, it might take you 6 months to a year to read it several times, and it takes a few months to absorb. It's not like you read the concepts, you read the formula, you will understand it the first time. I didn't. It took me some time to understand how it works. So if I can do it over several weekends to have you get 6 months or to a year's repeated reading to absorb something in 4 weekends and find it easy to understand, that means I'm doing a good job. Right? So that is what we do. Instead of having you read the book, probably you end up reading it anyway after you finish the exam. But so that is what we'd hopefully try to do. So something about me first. I was an ex-accountant, but I found it too reactive. So I struggled away and do finance for a while. But back then, I was in iBanking, and the market wasn't as efficient as now. So the income was still good, so I got to retire pretty early. And then I did my doctoral degree, but now I come back in to do financial engineering for different people and have my own trading. So I teach here as well. So it's fun because it actually tickles me to be in this business because everything is new. When you look at what they do, in some way, it's very similar to what we teach. you can't say the same for CFA, right? So here, a lot of things we do, people actually do it real life, but maybe a little bit more complex, but they're doing on the same concept. So here, in terms of opportunities, I think that's the only place, the number in absolute terms might not be a lot, but it's the only place where you can actually have fun, although working hard. So I think that's what, doing hard work is worth. If you work a long time doing pitch books and doing the same, M&A deals, it's pretty boring after a while. After the fifth deal, you're doing the same comms every day. But here it's different every week. You can actually engineer different products for certain clients for their needs, and you can't do it anywhere else. So many demands from different places, both on the employment side and demand on risk and others. So it's a good place to be in. And then for your career-wise, we have many different people coming to class. We have, I don't know the stats, but we have more non-managers doing this. Some wants to be the manager someday. Some are the risk managers in the funds, or some are employees in family offices. They invest in private equity, hedge funds, commodity futures, and they get statements from different investments, and they don't know what they're doing. So they come here and try to figure out and help the boss understand the investment returns and what they do. So there's many, many places that's being used, even on the personal side. You can even do structured products on a website, on Hang Seng HSBC website, which you can't do a few years back. So it's getting more common. It's good for career and personal side as well. And then a lot of things Joe had mentioned. So I'm looking at it from more of an exam perspective here. For level 1, it's very general, which is very good for if you're not in AI and haven't looked at the other alternatives. So we have 5 or 6 different asset class. We have the hedge funds, private equity, and real estate and others. So in level 1, it's like a flat pancake where you get general information on each one in very general terms. So that is where the multiple choice in level 1 will be based on. Not heavy-duty calculation, not in-depth strategy analysis, just what do they do, basically. So it gives you a very good understanding of each asset class, how they make money, what's so special about the market itself and the investment. For level 2, you have, for each asset class, you have the general question as well, but you have some in-depth question in a certain asset class on one item. So for example, one of the major things you have to do is convertible bonds valuation. That's in level 2 under hedge funds. So you'll be doing your actual calculation of how to value and convertible with all the implied options being built in. So level 2 gives you more in-depth knowledge on one topic in each asset class. For level 1, it's quantitative. There's quite a bit of quants in it. Most will look familiar from your like stats class in college, but here it's more from an AI perspective, because we're not trying to get standard deviation, but we're trying to figure out if I have certain asset like real estate, what does it look like in terms of return? So it helps you allocate your investments, right? It's really for that purpose, so you have to know all those. In level 2, most of the questions have two things. One is qualitative, so this describing how certain asset works, what's so special about it. The other is the calculation part. So that is what we'll do quite a few of how to do each one step by step, because you get the full answer in front of you in the book, but there's a certain way that's easy to do if you understand the steps. I'm a lazy person. I don't memorize formulas, because I mean so many, how can you memorize them all, right? So once you know the concept and how things work, you can backward deduct what should go in. You get the wrong answer, you can see it just by the look. That's what you should get to. So for the calculation questions, let me jump this part because this is for someone that took it before, but some would apply as well for the growth opportunities in the business. For the calculation questions, you can, it's not a distinct type, but you'll find two different way questions are asked. These are for calculation, conceptual, formula type. One would be the difficult but mechanical type, where you have a certain steps to calculate. So for example, private equity fees is one of the more tedious calculations because there's so many of them, right? You have your legal fees up front, management fee, there's offsetting for some of these. So once you know the step, you can't miss, but it's tedious, you have to get it right. The other is more theoretical, but it's easier if you understand. If you don't understand how the binomial tree works, you memorize the formula. It doesn't matter what you do. You can never figure out which one is wrong, correct answer because you don't know it conceptually. So it'll be like that, where it's a very short half-sentence question, and it'll be very, I guess, vague from the look. But once you know the concept, you look at it and you know right away which one is the right answer without even thinking. So that would be where we come in to help you figure out what the formula does, why this is on top, why that is at the bottom, and why minus the other part. So example would be bond valuation or CDS, where they use binomial trees in this case. So these are examples of various fees under the tedious type calculations. So there's two main things here. One, it's really for your protection as an investor, right? Because private equity is around for 7-10 years. It's almost like marriage, where you're stuck and you can't get out. So if you are signing, you want protection. So that is where the fees come in, is to protect the investor, to make sure 7 years later I get what I invested. So you have all these fees, management fees, and so on. The last two are for the protection, right? Where we have the hurdle rate, promised return at least of a certain amount, and then some clawback, and then there's waterfall on the performance fees. So all these can be quite a bit of calculations, but it's just tedious and step repeating. So that is one type. The other more vague one is on option valuation. So I mean, if you look at an option, if you have done the basic option formula, you have your delta, theta, etc. If you know the concept, you know it should be a minus sign. You don't even have to do the calculation. You can pick, oh, two answers are positive, two is negative. This is a negative delta option, so these two must be one of those. Number between 0 and 1, or 0 minus 1. So if one is minus 2, one is minus 0.5, you got the answer, right? So it's straightforward, but you must know the concept. Right, so CDS, binomial tree are that way, and option valuation. So that's all we'll do. So here, I'm trying to demonstrate to you, there are 5 questions we'll do. Here, you can figure out the answer just by common sense, logic. If you think about what they do. So here, these are some part on qualitative. So this come out in level 1 in structured products of buying CDS, credit default swap. So here you have to separate the risk. If you're buying health insurance, you have to specify, do I buy general health insurance or do you buy serious illness? So you can make the proper claim, right? So this is the same in this case. When you buy CDS, you want protection at what level? Do you want protection only when they default, or do you only want protection when they have some grading change? Right? So you must buy the correct one. If you are an investment grade manager of a bond funds, and you must sell the investment once it go below BBB, then you want one that hits and pay you back when you get a bond downgrade. You can't wait till it defaults, right? It'll be too late for you. So you have to separate between different level of credit deterioration, which is why it's put in here. We don't actually calculate it at different levels, but when you quote or when you use it real life, then you must specify when do you get payback claims for your health insurance, right? So normally the credit spread risk is your normal market-based, which is very hard to claim. So it's just a normal movement of the price because of market conditions. You can buy based on downgrade risk, right? So you can buy if my bonds I hold get downgraded to BBB or below, you pay me back the full face. So even if I sell at a loss, I won't have losses in my funds. Or if you are a mezzanine investor, you can buy for default, where you don't get paid back until the borrower defaults, and then you get your money back. So these are different levels you can buy your protection at. This is the two model we'll do. There's some calculations in the curriculum for these, but here just put it in because it's the most satisfaction I get from, I'm a FRM as well. So when you look at, it's a good structure where CAIA is striving to make the most money you can, the highest return. But to be honest, monkeys can make consistent return by luck. So that's where the FRM risk part come in, right? If you are very good, you have enough risk measurement to protect you even on the downside. So that's the difference between a man and a boy. Anyone can play, but you don't want to get hurt. So when I listened to one of the GOP, which is FRM webcast, they invited a guy which runs, I forgot, some desk in some major, I think it's UBS or someplace. He runs a desk for CDS. And he's having a 1-hour webcast on his credit CDS model. And he started with structure model. So he started doing this. And so we're actually doing the same thing as he does. And he runs one of the biggest banks' CDS department. So everything here is very useful. It's not some conceptual things they do. So structural model, these two are like your stock analyst. When you talk to a Goldman Sachs stock analyst, he uses his own cash flow and get to a target stock price of his own analysis, right? So he never assume market price correct. He look at his own numbers to target a stock price in the future. That's a structural model. So they don't look at market price. They look at your own analysis and say, what's the chance of default? Second one is like your option valuation. You assume market price correct and back out what's in it. Right? So these are the two. We don't do structural models. We look at a few option-based, like Black-Scholes, Merton models. But reduced form we'll look at with a few formulas, assuming market price correct and back out chance of default from the binomial tree model. So that's what we'll do in those two. But that's the qualitative part. So these, we have 3 questions coming up. This will help you, maybe you decide the exam is actually not too bad. Many are common sense based, right? So let's look at this first one. He's assuming a sudden increase in inflation. So suddenly inflation is much higher than expected. So when you look at this, there's a little thing in the book about this in the real asset section, as these are more of you buy a big apartment building, right? So you're collecting rent as an investor. So for these, who's like to benefit? So most of these, you can look at it from, if you're the actual investor, what happens to you, right? So let's say I have lots of money. I bought this building, and I rent to Kaplan. Normally they're long contracts, right? So I signed 10-year contract with certain inflation adjustment for the next 10 years. But when I sign, I expect 3-5% inflation. But for some reason, renminbi depreciated down 30% next week. High inflation in Hong Kong, hyperinflation in China. So suddenly, who benefits, who loses, depends on how my terms are, right? So here, if I have long leases, do I benefit as the building owner? I won't, right? Because my inflation adjustment is capped. But if market inflation is much higher, I'm actually losing money in real terms. Because inflation higher, I'm getting a smaller and smaller amount in real terms, right? So in next, I don't benefit. So A is out. For B, this is my revenue side. When you look at my perspective as a landlord, right, it's my revenue side. These two are my cost side. So I'm paying. If I have an adjustable rate mortgage, inflation goes up, it goes up with it. So there's no loss for me, but there's no benefit either, right? So it might possible, but we'll see what C is. So C is more a fixed rate loan. So in this case, I would benefit because now my loan is on a fixed lower amount while my rent is increased. So at least market rate goes up, my loan stays at a low rate, so it's benefit me as a landlord, right? So when you look through logistically, you can get to an answer in a logical fashion, right? So let's look at the next one. We haven't gone through this, but for private equity and real estate, the pricing for NAV is lagged because you don't actually buy sell real estate all the time. So most valuation are appraisals, which means they're smoothing. Price don't actually reflect actual market price, it's smoothed over time. So this is used to unsmooth the price. So in a way, this 0.6 means if I love pizza. If I order pizza every night, and let's say I order a pizza, this 0.6 means whatever I eat, I ate 0.4 of it, and 0.6 is always the leftover. So that means in this case, when I look at the prices or how many pizza I have at home, when I look, every day I have 0.6 left behind for tomorrow, which is a lagging factor. So when you look at this, if you look at price from 20 to 32 is the appraised price change. You call the agent, they say, oh, today your property is 20 million, next year it's 32 million. That means this is a $12 increase. That's my leftover, meaning the actual price change I don't know, but when I look at the appraised price, the increased is the 0.6 leftover of the actual price change. So I order pizza, I have 10 slides, 6 slides get left over. That's what I see. If you're asked how many slides initially to begin with, you back out to 10. Right? So 0.6 is that remaining factor. But when you look at the answer, you don't have to calculate, right? Because if you know the increase of 12 is 0.6 of the original, if you want to calculate, it'll be 12 is 0.6, so it's 20. What's the actual market price change? When you look at the answer, you know it has to be more than 12. So in this case, A, B, and D are impossible answers to begin with. So no calculations. Look at, it's smoothing is 0.6, increase is 12, actual price range must be more than 12. So only one possible answer out of all of these. Yeah. The last one we'll do. This one I'll give you a little bit more time, because this one it's you don't actually need to do the material to get the answer. I forget 1L or 2L, 1G or 2G. You get many of these for your futures and your commodities futures trading, because there's many flipping switch. When you read the question, if you're long or short, it makes a difference. Same calculation, same number, but plus or minus. because you're either short or long it, right? So here, there are actually many switches here. When you do the hedging for investor that had bought a commodity producer's debt, so here, these are the switches. For hedging, it's one way to screen out the answer. For the producer, which is our farmer here, when you look at futures, you have a buyer and a seller, right? So here we have two parties here. The question can say commodity user. So in this case, you're looking at the farmer, which is our character here, as our main character. And here, you have to hedge against his debt, not equity. So all these make for a unique answer, and going to default. So here, before we actually do the calculation, when you look at hedging, it screens out one answer. Because if you do hedge accounting or just hedging in general, when you use options, unless it's part of a collar, or if you're doing cover strategy, shorting options can never be a hedge, because you only got the premium and the downside. You never get the upside for the hedging, right? So for hedging any risk, selling the call option, whatever option is, cannot work. So you can screen that out, right? Next would be checking the producer, right? So now I'm the guy with the hay fork. He's making wheat and is selling to Kellogg to make your cornflakes. So depends on who you're asked. If they say the users, then the answer is opposite going forward, right? So you have to make sure you pick up all the switches in the question. So now I'm this guy, and for all these risk question, you figure out where it hurts, right? So I do the same revenue cost thing. So for the producer, what's its revenue? The guy selling the wheat. It's the market price for wheat, right? Because he get market price when he sells his wheat to Kellogg. So his revenue is cash coming in. His risk would be if market price go down, he would get less money, right? For the cost, it would be the feed, the fertilizer, and those. But here, his risk would be, the main one would be the market price of the commodity go down. That is his risk. That's where it hurts, right? So what I want is, I want to buy or sell something that makes me money when wheat price go down. So that would be his hedging, right? His revenue go down as wheat price go down. But whatever hedge we do for him, it must make money when the market price go down. So when you look at the choices, here call makes money when the price go up. So here you buy a call, it cannot be this one, right? The other would be you buy a put, so this way will work. You make money when the wheat price go down. You can sell futures as well. So these two are remaining options that can work. A and B is out already, right? If you're asked a users, it'll be the other way. But so now I know I'm down to these two. So now the last part is, how do I figure out C or D? You're hedging his debt, right? We haven't gone through this, but when you have the debt, what happens? Equity shareholder got the upside. Bondholders got the downside, right? If the firm goes down, shareholders runs away, debt holder gets stuck with what remains in the firm, right? If it's half of original value, debt holder get paid back half, 50%, 50 cents on the dollar. So in this case, when you look at a debt holder, it's not a symmetric return. For the debt holder, they're like this, right? Because when the firm does well, they earn the same interest anyway because it's debt. When the firm goes down, then they take the heat and the pain because the shareholders ran and left them with the firm. So by the look of the payoff, the debt holder should be using options as a put to hedge against this. When you put a long put on top of this, that is a perfect hedging, right? So why would so C is okay. So now why would D not work? which is on the other side, right? If I am like this to start with, this is my debt holder of the farmer. If I short a futures, I'll be like this, right? Because if I long a future, it'll be like this, short a futures like this. So if the price go down, I'm hedged. So this side is perfect. But what if the price go up? Then I'm unhedged. I'm actually negatively worse off than before. So option is the only one that will protect that profile in this question. But even we don't do those, you get 4 and you take 2 away, right? So that's it for the demo. I left you with 2 more questions. These you have the answer in the book, but these are actually very, very good. So let me tell you quickly what they do. This is using different option theory to value convertible or firms. So this Black-Scholes model, this Merton's model, it's very fun. This is on something that is different, but it's proved to be pretty useful real life. If I give you $10 billion tomorrow in cash, in many suitcases, you go and invest. Right? Normally, most people do is look at risk and return and allocate and decide what to buy. That's what most people do, right? For AI, some of the managers are going towards a risk approach to allocation. So instead of looking at highest return to risk, they look at, I want to make my risk level as how I allocate. So this is one of the way. Here we have total val, which is how they measure total portfolio risk. And within this, they have component val, which is, let's say I have 10 billion. I have equity, hedge funds, real estate, and private equity. They adjust the allocation not by return, but by looking at if I increase my allocation of real estate by 1%, how much more risk will I increase or decrease to figure out the allocation. So that is the calculation of why doing this with components or marginal val. There's only a small part on this, but it's just introduction to the concept in the curriculum. So these are all a lot of fun. You won't find these, I guess it can be challenging, but that's the fun part of it, right? When you talk to people in Lan Kwai Fong, everyone said they work in a bank. When you ask them these questions, they all look blank. So here, next part is Janet, and she'll tell you more about the different packages we have.